How do you know that it's time to cut your losses because your stock has dropped in value, or if it's time to double down and the stock is an even better price than it was when you bought it? I'm going to be going over my public YouTube portfolio. I've got 6 companies that are down. We're going into a recession. We're all going to have some companies that lose money. I'm going to show my thought processes, how I decide if it's time to cut my losses, or do I want to double down and hopefully make even more money. Let's get right into it. This is my public YouTube portfolio series. A little over half of the companies are green, but I've got 6 companies in the red that I need to make a decision on. Are these companies dropping in value for a good reason, or are they an even better deal than they were before? I'm going to start with the worst one, Zeta. Now, Zeta was a little bit not characteristic for me in this investing strategy because there was a specific catalyst that I was looking to take advantage of when I invested in Zeta. Normally, I'm looking purely at the future free cash flow valuation of companies to decide, do I want to invest? Are they undervalued enough? And do they have a durable competitive advantage over their peers? Now with Zeta, they had a massive sell-off. I'm pulling up the overview right now, last 5 years, right here, this big sell-off. Investors simultaneously had higher expectations for an earnings report that was coming out. And when the earnings report did not meet expectations, there was a massive sell-off. At the same time, there was a short report that came out that accused Zeta of scamming shareholders, basically. I read through the short report. It didn't look very credible to me. So I made my investment based on the fact that there was an overreaction by the market in 2 ways: overreaction for their earnings report and an overreaction on the short report. So I thought there would be a good short-term prospect for this company, and it just has not panned out. First, before I look at that, I want to look at their forecast. For Zeta's future revenue, the forecasts look really good. Even the lowest analysts are projecting 17% revenue growth, 18% in 2025, and then strong revenue growth going forward. The highest analysts are showing 30% revenue growth over the next 5 years. So the analysts are looking really strong. And when I put those future revenue projections into my discounted future cash flow spreadsheet, the intrinsic values are looking really solid. The lowest analysts put Zeta at 6% overvalued. That's the lowest analyst projections. That's this revenue projection right here. The average analyst put it at 28% undervalued, and the highest analyst put it at 60% undervalued. So at first glance, this looks really strong. And when I go to Zeta's own investor relations, their investor presentation, they are showing that they're targeting 20% growth by 2028, 20% revenue growth every year so that they can reach 2.1 billion in revenue at that time. So Zeta has really strong growth prospects. At first glance, they look really good in terms of their free cash flow. However, when I did my initial evaluation of this company, I did not take into account their stock-based compensation. So let's look a little bit closer at that number. If I go to their financials on stockanalysis.com, go to Cashflow, I can see that in 2024, they actually had $70 billion negative in income. So they're starting off at a loss. However, when they add back in their non-cash expenses, depreciation, amortization, they're adding back in stock compensation. So whenever you're calculating earnings, profit or loss, you are subtracting stock-based compensation. But when you're looking at the actual cash flow, since you're paying your employees in stock, you're not actually losing cash from that transaction. So that gets added back in, which pushes up your operating cash flow. So in 2024, Zeta had $134 million in operating cash flow. But the only reason they had positive operating cash flow is because they paid their employees almost $200 million in stock compensation. Now, the negative effect of that is their stock count, the number of shares outstanding, is constantly going up, which dilutes my shares. If I hold 1 share and then the number of stocks double over the next few years, then each of my shares is worth half as much in terms of company ownership, which is not good. So if I look at their income statement, this is where I can see their shares outstanding. I can see that in 2020, they had 33 million shares outstanding. And now the trailing 12 months, like their current shares outstanding, almost 200 million. So this company is diluting shareholders quite a bit. And I did not account for that so much in my analysis of this company because I was going for a short-term play on this company. And so future dilution, I wasn't as worried about. But now that I'm thinking, do I want to hold this stock a little bit longer term because my initial thought process hasn't played out. Now I'm paying more attention to some of these nuances. So when I account for stock-based compensation, if I'm going to reduce their free cash flow by that, then their free cash flow margin drops quite a bit. So without accounting for stock-based compensation, their past free cash flow margin over the last 5 years is 9%. And it has been on the rise. This graph shows their trend. So that all looked good. But after I reduce their free cash flow by their stock-based compensation, now they are showing negative free cash flow, which I have a hard time valuing a company that has negative free cash flow. So I tend to stay away from companies like these. Now that my short-term catalysts have not played out the way I thought, I've decided to cut ties with Zeta. I'm going to go ahead and take the loss. If I go back to my portfolio, I can see that I have lost $22.67. And that's one of the benefits of having a well-diversified portfolio. For this series, I'm investing $100 every week into a new company. So a single bad investment isn't going to hurt me. It's not going to hurt me that bad. So Zeta, unfortunately, lost $22. I'm going to sell this company and I'm going to use the cash to double down into one of the companies on this list that looks strong. My second worst holding in terms of how much I'm down is Google, believe it or not. So when I go to Google's current share price, they're at $165 per share. Looking at their past price action, they have been going up a little bit over the last month, but they're still down quite a bit for me. So first thing to check out, how does their future revenue guidance look? In terms of forecast on stockanalysis.com, it looks pretty strong with the highest analysts projecting 20% revenue growth over the next 5 years. That's really strong. The average analysts are still in the double-digit percentage revenue growth, and the lowest analysts are showing a little bit of increase here, some losses over the next 3 years, maybe pricing in a little bit more the recession possibility. Now, when I enter that information into my automated spreadsheet, I am assuming over the next 5 years, I'm using the analyst revenue projections multiplied by Google's free cash flow margin. The highest analysts are giving me an upside of 112%. The average analysts are giving me an upside of 69%. And the lowest analysts are giving me an upside of 22%. In terms of the lowest analyst projections, Google is undervalued. Now, I am assuming 5% growth in years 6 through 10, and then a permanent or a perpetual growth rate of 3% going forward. Now, how is Google priced currently? What do investors think is going to happen, or what does the market think is going to happen? When I put in a 5% growth rate over the next 5 years, a 5% growth rate over the next 5 years after that, and 3% growth rate going forward, this is my projection. I get an intrinsic value of $169 per share, 2% undervalued. So this is what investors think is going to happen. Low or mid single digit growth going forward. And just based on what the analysts are saying, most analysts are saying double digit revenue growth. I think Google is a fairly safe investment. Now, when I look at Google's own revenue guidance, I do have some cause for concern. So right here, the only spot I could find where they're talking about future guidance. Turning to our outlook, I would like to provide commentary on several factors that will impact our business performance in the second quarter and the remainder of 2025. So first, in terms of revenue, they're talking about Google services. Advertising revenue will be impacted by lapping strength. Second, in terms of cloud, tight demand supply environment. So they are laying out some scenarios here where their growth will be impacted. Second, moving to their investments, they are expecting capital expenditures to invest $75 billion. When I look at their previous capital expenditures investment, just to get a comparison, go to Cashflow, we saw $57 billion over the last 12 months, $52 billion in fiscal year 2024. So they are increasing their capital expenditures investment. They are investing mostly in data centers and servers to facilitate their future growth. So they do have an aggressive capital expenditures future investments. However, this is going to affect their profit loss bottom line. Right here, they say this will put pressure on the P&L primarily in the form of higher depreciation. So they're laying it out. They're going to hurt a little bit in terms of their profit going forward in the next 5 years or so. They're going to hurt a little bit in terms of free cash flow. But what that means to me is they're not going to grow their free cash flow as much, maybe as the upper analysts think might happen. But that still would put me in line. If the lowest analysts are correct, I'm still looking at a 22% upside. So even though Google is cautiously optimistic going forward, they're putting their money where their mouth is. They are putting $75 billion aside for capital investment. They also reference how much money they're putting aside for stock buybacks. As we announced today, our board of directors declared a 5% increase to our quarterly dividend, also approved $70 billion in share repurchase authorization. So Google, they're spending their money with confidence. Their share price appears to be undervalued in terms of future free cash flow. I'm going to be doubling down on Google. My third worst holding on my YouTube public portfolio is DocuSign. It is down 12% since I bought it. Their current share price is $82.11. If I go to their forecast for future revenue, their forecast looks pretty solid. The highest analysts being double digit revenue growth, the average analyst being upper single-digit revenue growth, and then the lowest analyst looking at 0% revenue growth over the next 5 years. Now, when I go to DocuSign's own revenue guidance, they say for 2026, they're targeting $3.13 billion. That would mean 5% revenue growth. So that is what I have entered in as my own personal projection for revenue growth. So over the next 5 years, I put 5%. For years 6 through 10, I put 5%. And then the perpetual growth rate, 3%. That puts, according to my projection, their current share price just slightly overvalued, but with the analyst projections, the average analyst puts them at 8% undervalued. The highest analyst give me an upside of 40%. What am I going to do? Now, when I bought this company, one thing that I overlooked was how much they use stock-based compensation. So let's go to their financials really quick. I find this information in their cash flow statement. So right here, their net income, $1 billion, their stock-based compensation, $600 million in 2025, 616 in 2024. You can see that trend has been pretty consistent. They give away a lot of stock. Now, when I look at how they're spending their free cash flow, I can see that they are also repurchasing common stock. In 2025, they repurchased 900 million. So here's my issue. They're paying $600 million worth of stock to their employees, which makes their free cash flow look higher than it is. And then they're turning around and they're taking that free cash flow and they're using it to buy back shares. So what I should do when I'm analyzing this company's free cash flow is I need to reduce their current free cash flow by how much they are putting into stock-based compensation or how much they're benefiting from it. So when I adjust my spreadsheet accordingly, so currently this is assuming a past free cash flow margin average of 23%. And when I look at their past free cash flow margin here, it has been going up, which all of that looks really great. However, if I reduce their free cash flow by 90% of their stock-based compensation, now their 2025 free cash flow margin is 14% instead of 30%. So it's dropping by quite a bit. Now, if I go back to 2023 through 2021, it's as if they almost had zero free cash flow margin. I guess in 2022, they had 5.8% margin. So I need to reduce this number by quite a bit. I'm going to give them their most recent high in terms of free cash flow, which would be 14%. That means I'm going to reduce their free cash flow by 9%. And then I'll give credit to them for future free cash flow growth because they are trending in that direction. 1% free cash flow growth over the next 5 years. And the result is now their share price is actually overvalued. It doesn't look near as good when I am factoring in their stock-based compensation. And this is something that I didn't check at first. In the past, I gave them credit for their stock-based compensation. Now that I'm taking away that credit, it changes the story quite a bit. So in my mind, DocuSign has gone down. If I was making the decision to invest in them today at their current share price, now that I am truly taking into account their stock-based compensation, I don't think I would. I don't think I would invest in this company again. So I'm going to pull the plug on DocuSign and put that money into a company that looks even more undervalued than it did when I purchased it. My fourth worst holding is ACAM or Akamai Technologies. I hope I'm pronouncing that right. If you're not familiar with this company, they're currently trading at $82.54 per share. And they are cybersecurity, cloud computing, and here are their three business arms: cybersecurity, cloud computing, content delivery. And we look at the evolution of their business. They are slowly moving towards more and more cybersecurity, which was my investment thesis when I initially invested in this company. I think cybersecurity is a growing trend. I want market leaders in cybersecurity that are also discounted in terms of their future free cash flow. So if I want to see ACAM's forward guidance for their revenue, I can see that right here. Total revenue, 3 to 5 year goal. They are hoping to reach 10% year over year growth in terms of revenue. So that is what I'm going to put in for my personal revenue projection. In terms of the professional analysts on stockanalysis.com, if I go to the forecast tab, you can see the analysts are showing on the upper end 10, 13, 18, 17, really high double-digit revenue growth. The average analysts are showing 5 to 10% revenue growth, and the lowest analysts are showing a little bit of revenue contraction. So what does that mean in terms of their discounted free cash flow? Well, we can see it right here. So here I've entered in my projection, 10%, followed by 5% for years 6 through 10, and then 3% revenue growth going into infinity. The result is the lowest analyst projections show 14% undervalued. The average analysts give me 76% upside, and then the highest analysts, 147% upside. With my projection, that's 10% revenue growth, which is their goal, followed by 5 and then 3. That gives me 96% upside. So all of that looks really good. However, we still have to take into account the stock-based compensation. Whenever I go to their financials, and I like the way they spend their cash. If I look at their operating cash flow, I see $1.5 billion, 400 million of that was stock-based compensation. So that is a little bit high. However, when I look at how they're investing their cash, I see $500,000 in CapEx, $434 million in cash acquisitions. They're acquiring businesses. If I scroll down a little further, I can see they've repurchased $730 million in common stock. But I do need to take into account the stock-based compensation. So I have to adjust their free cash flow margin. Right here is where I am calculating that number. Their new average free cash flow margin is 19.62. That's about 20% if I take 90% of their stock-based compensation away from their free cash flow. So after I take that into account, I need to reduce their free cash flow by about 5%. Now the result is the lowest analysts are showing a 13% downside, but my projection is still a 52% upside, and the average analyst is still a 36% upside. I still think that ACAM is really undervalued. They look solid. I love the story behind this business, how they are moving into cybersecurity, I believe is going to be growing and growing importance. If I look at their shares outstanding, they're constantly dropping their share count. They're buying back more shares than they are issuing. All of that looks really good. I'm going to be doubling down on ACAM. The fifth worst company in my portfolio is SMPL, Simply Good Foods. This company is currently trading at $36.72. This is a consumer packaged food and beverage company. They engage in marketing, sale, and snacks and meal replacements. The trends that I have observed is more and more people wanting healthier food options and a greater desire for convenient health food options. Simply Good Foods fits that mold. I love the story. That was my original investment thesis. Now let's see, what does their future free cash flow look like? When I go to their forecast section on stockanalysis.com, I'm seeing a solid revenue growth projection, double-digit revenue growth for the highest analyst, mid-digit growth for the average, and then the lowest analysts are thinking pretty much flat on the revenue. Now, if I go to their own internal guidance, right here on their press release, this is April 9th, they are saying net sales expected to increase about 9% in fiscal year 2025. So for the next year, they're saying 9%. I'm going to go with 5% for the next 5 years. So on my calculation right here, putting 5% for years 1 through 5, 5% for years 6 through 10, and then 3% going into infinity. That gives me an upside of 10%. Now, do I need to adjust their free cash flow because of stock-based compensation? This time, the answer is no. If I go to their financials, cash flow statement, I can see that they only have 18 million over the last 12 months in stock-based compensation. That's relatively low. When I scroll down to their repurchase of common stock, they're really not repurchasing much, but I am going to take the stock-based compensation against their free cash flow, but it has very little effect. When I look at how they're spending their cash that they have, their free cash flow, I can see in the investing category, they are acquiring businesses, $1 billion in 2020, $280 million in 2024. When I go to the financing category, I see that they're repaying their debt, see that they're buying back just a little bit of stock, and that's about it. So they're acquiring businesses, they are growing their cash pool. That's another thing that I can see right here. In 2022, they had cash and short-term investments of $67 million. They have doubled that now. They're at $132 million in cash. They're building up their cash cushion. They're paying off their debt. Their goodwill is continuing to go up. That means that none of their acquisitions have shown to be bad so far. If they have to admit that they acquired a business that's overvalued, then you'll see that hit on the goodwill, that you'll see the goodwill take a hit. That has not happened. If I go down to their retained earnings is consistently going up over the last 6 years, going back to fiscal year 2029. So this company looks really strong in terms of how they're spending their cash. But how do they look in terms of free cash flow? The lowest analysts are giving them 6% overvalued, whereas the average analyst gives them an upside of 19%. If I use my projection, I'm seeing an upside of 10%. However, there's one more thing I want to give them credit for. That is their continual rising free cash flow margin. I'm seeing a trend where they're getting more and more efficient in their operations. So I'm going to give them credit for that. 1% free cash flow growth over the next 5 years. That's shown right here on this graph. That brings their upside way up. If they can have a free cash flow margin in 5 years, that's mirroring their current free cash flow margin. So I'm saying the average is going to grow. Their current free cash flow margin is a little over 15. If they can end up about that point, then their free cash flow is going to be growing quite a bit. And that puts the lowest analyst projections now at a 35% upside. I think that's a reasonable estimate considering the trend where people are having more desire to have healthy food options. Convenient food options is always becoming a trend. People want convenience as we go forward. So I think the story is great. The valuation looks great. I am going to be doubling down on Simply Good Foods. My sixth worst holding is Canadian Natural Resources. It's only down about 3.5%, but let's take a quick look. So on stockanalysis.com, Canadian Natural Resources Limited is trading at $29 per share. This is in USD. If I look at the year to date, they have dropped about 6%. My drop is all of this stuff with tariffs, how Trump and Canada are not really getting along, and we are tariffing Canada. That is the result. So my question is, are the future free cash flows going to be affected enough to make me want to drop this company? So first things first, let's look at the forecast. I don't normally look at this. This is what the analyst price projections are for this stock, which there's a pretty tight range right there. So the lowest think this price is going to go up to 57. The highest thing it's going to go up to 63, but I like to use their revenue projections, not their price projections, because I don't know necessarily what the analysts are using to come up with those price projections. Down to revenue, there's a wide range. The highest are saying 100% revenue growth. The lowest are saying 18% revenue drop. I'm expecting a wide range of intrinsic values now because of this. So let's paste that into my spreadsheet. With those projections, we have a wide range of intrinsic values. The lowest analysts are saying a 53% downside. The highest analysts are saying a 500% upside. The average analysts are saying a 58% upside. And one thing to note, I did have to add this to the spreadsheet. This is the exchange rate. I did notice that on stockanalysis.com, if I go to the financials, these are the numbers that I'm using to make my calculations. These are in Canadian dollars while the share price is in US dollars. So I run my calculations in Canadian dollars and then can make the conversion at the very end. So that is the reason for this new box right here. With my projected revenue growth, I'm just putting in 3%. I'm saying it's going to grow on average with respect to inflation. I'm getting a 73% upside. If they're able to grow their revenue based on their past growth, then we've got a 200% upside. When I look at C&Q's own guidance right here, this came out in April of 2025. So this is relatively recent. Let me scroll down here. This is showing their dividend growth. A lot of times you can use dividend growth as a proxy for their free cash flow because dividends are paid out using free cash flow. We can see that they have 25 consecutive years of 21% annual dividend growth. That looks really strong. They show 2025 right here is on track to continue increasing their dividends. That tells me that they are confident in their future revenues, at least for 2025. And if I look at their long-term dividend growth versus their global peers, their 10-year CAGR, it shows right here, way higher than their peers. That looks really strong. Their annualized dividend increased in 2025 to $2.35 per share. All of that looks really strong. If I continue to scroll down here, I can see their budget for 2025. They're increasing their capital expenditures. That's a sign of confidence. They're increasing their production. And right here, I can see their production levels increasing. So they have had a historic production growth of 9%. In 2025, they are targeting 12 to 16%. So they're actually showing an accelerated production compared to their past. Now, production increases do not necessarily result in revenue increases because that is going to be strongly correlated with the price of oil per barrel. So this doesn't tell the whole picture, but they are increasing their production going forward. So to me, that is a strong sign of confidence. I might adjust my future revenue growth to, let's knock everything down to 2%. That still shows a 34% upside. If I knock all of their revenue growth down to 1%, less than inflation, then I'm still seeing a 7% revenue growth. Let's look at their dividend. This company represents a 5.5% dividend. How much do they spend on share buybacks? If I go to their financials, cash flow, stock-based compensation, $279 million, relatively low. If I scroll down to their repurchase of common stock, $2.66 billion. huge share buybacks, 4.4 billion in dividends. So what this company represents to me is a cash flow machine. Even if they don't have strong revenue growth going forward, their price is low enough that they're buying back enough shares and paying out enough in dividends that I feel comfortable with my shareholder return with their future free cash flow projections. So I'm going to be doubling down on Canadian national natural resources. My favorite way to protect my portfolio from a looming recession is to invest in companies that are undervalued in terms of their discounted future cash flow, but they still have strong growth opportunities. If you want to combine growth and value, check out this video right here. Cheers.